seeing those. The trust needs to return. And I think in all these instances, these are attempts to regain trust, both in the revelations, like we're arcing back to truth with what happened over 19, and in money with China going the gold vaulting and knowing that gold is fundamental to trust. Deep down, you and I both know gold is money and everything else is credit. And I think the smart minds know that they've got to win that game and establish that credit, that real money, for any form of trade system to have the same trust or better trust than the failing one that we're busy witnessing.
Yeah, there's no question gold is becoming tokenized. I can tell you, I know this to be true. My feeling is that it's moving more towards the institutional to challenge the ETF market, redeemability, transparency, the ability to post for collateral, all of these things you don't get with the ETFs, plus you're paying BlackRock and JP Morgan a 50 basis point management fee. I do think tokenization is coming. But I guess on a bigger level, why gold? Why, again, going back to the first question, everything's okay. Why are we seeing governments accumulating gold the way that they are if the dollar system is supposedly perfectly healthy? And do you think, I guess even more to my own curiosity for what you're going to say, do you think gold is becoming infrastructure or is it becoming an asset? I think that's, to me, the bigger question. Is it an asset to own or is it part of a coming infrastructure?
That's an interesting question. Is it an asset or infrastructure? I tend to say it's ultimate money and it's preservation of value. So it's a wealth preservational tool that will transcend systems dying. I refer to it as the golden arch, from the rickety old train onto the new monorail. Even though the old train is going to go off the cliff in the end, it will carry whatever wealth, whatever you put into it while on the old system, you will get to transport over to the new system. However, there will always be institutional traps as well, and I do consider tokenization of your wealth as part of declaring your wealth for all to know, and tax attacks vectors and other forms that could be subsequently weaponized against you in lieu of gains. It's quite ironic and a slight departure maybe from your question, but it's amazing to me that in a fiat debasement world where inflation is policy by all central banks and inherently our buying power is being eroded away, that there is such an evil tax such as capital gains on the basis that it's not like for like. You've been put into monkey money, you're a monkey on a grease pole and you're slipping down perpetually, and to have retained value creates an artificial impression of actually being given some windfall you just didn't deserve that deserves to face taxation.
Welcome back to Financial Weekly, where we break down the biggest developments affecting gold, precious metals, currencies, and the global financial system. If you just watched that discussion, you heard an argument that goes much deeper than the price of gold. The real issue is trust. Trust in government debt. Trust in financial institutions. Trust in currencies. And ultimately, trust in the system responsible for recording, transferring, and preserving our wealth. For decades, the international financial system has operated primarily through credit. Governments issue debt. Banks create loans. Central banks manage currencies, and financial institutions process transactions based on the belief that every obligation will be honored. When that confidence is strong, the system can expand. When that confidence begins to weaken, investors start searching for assets that do not depend entirely on another institution's promise. That is where gold enters the conversation. But gold may be evolving beyond its traditional role as an asset stored inside a vault. It may be becoming part of the infrastructure supporting a new generation of international trade and financial settlement. Today, we are going to examine why countries are accumulating gold, why alternative payment systems are being developed, what gold tokenization could mean, and how investors can separate genuine monetary change from exaggerated predictions. Let's begin with the breakdown in trust. Normally, rising interest rates in a major economy can strengthen its currency. Higher rates attract international capital because investors can potentially earn a greater return from that country's bonds and financial assets. But rising rates can also reveal weaknesses. Governments must refinance existing debt at higher costs. Businesses face more expensive loans. Consumers pay more for mortgages and credit. Investments that appeared profitable when money was cheap may no longer work when the cost of capital rises. This is especially important in private credit and private equity. Many private assets are not priced every second of the day like publicly traded stocks. Their valuations may be based on models, periodic estimates, or assumptions developed when interest rates were considerably lower. When investors attempt to withdraw money, financial managers may discover that selling those assets quickly would require accepting much lower prices. In some funds, withdrawals can be limited or delayed to prevent forced selling. Those restrictions do not automatically mean the entire financial system is collapsing. Some investment vehicles are specifically designed to hold assets that cannot be sold immediately. But widespread redemption limits can still reveal a serious mismatch. Investors may believe they have access to their money, while the underlying assets are locked into long-term or illiquid investments. When confidence falls, liquidity becomes more valuable. Investors stop asking only, "What return can I earn?" They begin asking, "Can I access my money when I need it?" That shift in thinking can have enormous consequences. Now consider the international monetary system. The US dollar remains central to global trade, banking, and reserves. Replacing it would be extremely difficult because the dollar system has enormous financial markets, established institutions, legal infrastructure, and worldwide acceptance. But countries do not have to replace the dollar completely to reduce their dependence on it. They can build parallel systems. A parallel payment network allows countries to settle certain transactions outside the traditional dollar-based channels. Two trading partners may use local currencies, digital settlement platforms, direct commodity exchange, or assets held inside regional vaults. The goal may not be to destroy the existing system. The goal may be to create another option. That difference matters. A country dependent on only one payment network has limited flexibility. A country with several settlement options has greater bargaining power and may be better protected if political conflict interrupts access to one system. This is one reason nations across Asia and the broader global South have explored new financial connections. They are building alternative rails before an emergency forces them to do so. Think about it like a city constructing a second bridge. The new bridge does not have to eliminate the original bridge. Its existence provides an alternative route if the first becomes overcrowded, damaged, expensive, or politically restricted. Gold can play an important role in this developing structure because it is recognized internationally and does not belong exclusively to one country. A currency is issued by a government. A government bond is a promise from an issuer. A bank deposit is a liability of a financial institution. Physical gold is different. It carries no credit risk when it is owned outright and securely stored. It does not require another party to make a future payment, and its supply cannot be expanded by a central bank decision. That does not make gold perfect. Its market price fluctuates. Storage and insurance cost money. Transporting large quantities can be difficult, and ownership rules vary across jurisdictions. But gold has one characteristic modern financial systems frequently lack. It can settle value without creating a new debt. That is why continued gold purchases by central banks deserve attention. If policymakers believed the existing monetary system carried no meaningful risk, there would be less urgency to increase exposure to a non-yielding reserve asset. Central banks accumulating gold does not necessarily mean they expect an immediate dollar collapse. It may simply mean they recognize the value of diversification. A reserve manager does not need to believe that government bonds will become worthless to decide that holding too many bonds from one country creates unnecessary risk. Gold provides an alternative reserve that can remain valuable across political and monetary changes. This brings us to a fascinating question. Is gold simply an asset, or is it becoming financial infrastructure? The answer may be both. For an individual investor, gold may function as a store of value, portfolio diversifier, or form of financial insurance. For a central bank, it may function as a reserve asset. But when gold is used as collateral, incorporated into payment systems, or transferred through digital ownership records, it begins functioning as infrastructure. That is where tokenization enters the picture. Tokenized gold generally represents ownership or a claim connected to physical gold recorded through a digital system. In theory, this can make gold easier to divide, transfer, verify, and use as collateral. Instead of physically shipping a gold bar each time ownership changes, the digital record can be transferred while the metal remains inside a secure vault. That could create several advantages. Transactions may settle faster. Smaller investors may gain access to fractional ownership. Institutions may be able to transfer gold-backed collateral more efficiently. Auditing technology could potentially improve transparency if the system is properly designed. But the word gold-backed does not eliminate counterparty risk. Investors must ask important questions. Who owns the physical metal? Where is it stored? Is it independently audited? Does every token correspond to a specific quantity of gold? Can the holder redeem the token for physical metal? What fees, restrictions, or minimums apply? What happens if the company fails? And can the token issuer freeze or reverse transactions? A gold token is not automatically equivalent to holding a gold coin or bar directly. The quality of the product depends on the legal ownership structure, custody arrangement, auditing standards, technology, and redemption terms. If the token represents only an unsecured promise from a private company, the investor may hold more counterparty risk than expected. This is the same distinction investors must make with exchange-traded funds. Some investors use gold ETFs for liquidity and convenience. They can buy or sell through a brokerage account without arranging physical storage. But an ETF share, a gold-backed token, and a physical coin are three different forms of exposure. Each has advantages and limitations. Physical gold provides direct ownership but requires safe storage and may carry larger transaction costs. An ETF can be highly liquid but depends on custodians, fund rules, and financial market access. A token may provide rapid transfer and fractional ownership, but introduces technology, issuer, regulatory, and cybersecurity risks. Investors should understand what they own rather than assuming every gold-related product offers identical protection. Privacy is another concern. Digital financial assets can create permanent transaction records that may improve accountability and reduce certain forms of fraud, but it can also increase surveillance. If ownership is connected to a verified identity, Authorities, financial institutions, or platform operators may be able to monitor balances and transactions. Whether that is viewed as protection or intrusion depends on the person and the system. Taxation must also be considered carefully. When the price of gold rises in currency terms, part of that increase may reflect the declining purchasing power of the currency. An investor may feel that gold merely preserved value, yet tax law may still recognize a nominal capital gain when the asset is sold. The specific rules depend on the investor's country, location, holding period, type of product, and individual circumstances. Tokenization does not automatically eliminate taxes. In some situations, exchanging, selling, redeeming, or transferring a token could create a reportable event. That is why investors should consult a qualified tax professional rather than relying on broad claims made in online discussions. Now let's return to the larger picture. Does the development of alternative payment systems mean the dollar is about to disappear? Probably not overnight. Reserve currency transitions generally take time. The dollar remains deeply embedded in global finance, and competing systems face their own challenges involving trust, transparency, capital controls, political influence, and legal enforcement. A new financial network is not automatically more trustworthy simply because it is new. Trust must be earned through consistent rules, reliable settlement, transparent reserves, and fair treatment of participants. However, the direction of change still matters. If more trade is settled outside the dollar, more gold is stored in regional vaults, and more countries diversify their reserves, the global monetary system could gradually become more multipolar. Instead of one dominant financial center, we may see several connected systems. Gold may serve as a bridge between them because it can be recognized even when countries do not completely trust one another's currencies. That may be gold's most important future role, not necessarily replacing every currency, not necessarily returning the world to a traditional gold standard, but functioning as neutral collateral in a world where confidence is divided. For individual investors, the lesson is not to panic or assume an immediate monetary collapse. The lesson is to examine concentration risk. How much of your financial security depends on one bank, one currency, one brokerage, one payment network, or one category of asset?